So Trump tariff is having a huge impact on all the global indexes. The markets are falling everywhere, be it China, Japan, be it US, Europe, India, everywhere it's falling. So Indian market today fell by a huge number, 750 points down. It is around 22,161. It went down to as low as 21,750. There are a lot of questions that's been asked by subscribers, viewers, and a lot of people in WhatsApp keep asking this question. Is this a good time to start by people who have cash or who can arrange cash? They are the ones who are asking this question. Or should I wait for some more time before starting to deploy cash? So whenever I look at Nifty, right, I follow a basic thumb rule. So if you look at the Nifty 50 valuation, right, so it has a market cap of 1.81 lakhs. So at current EPS of it has a P ratio of 20.8. So it has a current price of 22,162, at which it closed around this price. So the current P ratio of Nifty is 20.8. Is this cheap? Is this expensive? Let's look at it. So here is the basic thumb rule I generally follow. So if the P ratio of Nifty is greater than 25, it is considered very expensive. This is not something that is followed just by me. Even some of the top investors who have several crores of money, even they also follow this basic simple rule. So the P ratio is greater than 25, the market is very expensive. Start selling your holdings, move your money to debt fund, move your money to fixed deposit. So this is what some of the top investors do. I personally know a lot of them, and they did it even in the last cycle when the market was very expensive. Now the second phase, the price to earnings ratio is less than 25 and P is greater than 20. So if it is hovering between 20 to 25, it means that the market is still slightly overvalued. So you can hold on to your existing shares, but don't buy anything new because it is still overvalued. Now let's look at the next number. What if the P ratio goes below 20 and it stays above 50? So at this price point, it is extremely undervalued. So the P ratio is greater than 15, and if it goes below 20, so we saw that the Nifty P ratio is now at 20.8. It is very close to what we are looking at. So it is very close towards becoming undervalued. So you can start buying at these prices. What if the P ratio becomes less than 15? It means that the market is available at an extremely discounted price. Right, exactly like how your big day sales happens in Amazon or Flipkart, where you keep buying, you get opportunities to buy iPhone at 5 rupees, a lot of goods at cheap, extremely cheap discount. So it is exactly a situation similar to that. So in this situation, whatever money you have, you can invest. You can borrow money. You can take loans and invest. So this is what people say when the market is extremely cheap. So basically, if you have confusion about when is a good time to invest, is it time to start buying? So you can follow the simple thumb rule. We'll look at the graph of Nifty over the last 20 years and see whether this particular tactic worked. So let's go back to 2003. So 2003, 2004, 2005. So these were phenomenal years for India. So the GDP kept doubling every year. But again, the stock market also kept doubling. Even then, the market remained cheap, cheap, and cheap for a long period of time. Now let's look at it. January 2003, 14.65, extremely cheap. Buy. 14.3 to 13.83. So basically, here it did not mean that we were having a bad phase. The economy was growing fast, but still the markets were remaining at a cheap valuation. The economy, if the economy doubles, still the market has to catch up, right? So the P ratio remained undervalued for a long period of time. So 2003, you can see 13, 11, 12, 12.49, buy. So 19.06 December. So now let's go to 2004. 2004, it started becoming a little overvalued, 21.14, 20.31, 20.59. Again in April on, from April onwards, it started becoming very cheap. You can see 19, 14, 12, 13, 13, 14, 15. The entire year of 2003 and 2004 were buys. Same as the case in the year 2005. Maybe at that time we did not have a huge premium, but still you can see that 2003, 4, 5, you had kept buying by following the simple rule, you would have basically invested at a very low valuations. Now let's look at 2006. It started going up. Now it started becoming in April 2006. It started becoming a little lower valued. Again, May, June, July, August, September. So 4 months you can buy. So October, it started becoming overvalued. You can keep holding your existing shares. Now let's go to 2007, which was the year of huge returns. So again, even in 2007, you got a couple of months, February, March, April, May. Again, all these 4 months were opportunities to buy. June onwards, hold. July, hold. August, buy. September. From October, you can see from October 2007, market started becoming very expensive. 25.14, 26.14, very expensive. You have to sell your shares and wait for the better valuation. So in 2008 January, 26.6, and you can clearly see this, right? So just before the big burst which happened in 2008, just before the great economic depression, uh, we started having a huge valuation of the Nifty. It was at very high valuation, about 26. So ideally, if you are holding share, you should sell it in December and January and wait for it to become undervalued. So 22, in February 2008, it started falling. 22.27 overvalued. March, again overvalued. April, so slightly overvalued. April, May, June. June onwards, you are getting an opportunity to buy. June 2008, buy. 2008, July, buy. 2008, September, October and all, it is extremely cheap. You have to basically borrow money and buy. 12.29, 12.81. This is how it is. 2009, you can see. So here in May, the government came to par. UPA came to par for the second consecutive term. So till then, it was extremely cheap and a great opportunity to buy. Because of the election results, it went up a little up. And then, so if you are buying from here, from 2008 to June, could have started buying in 2008 June and continued till May 2009, and then you could have started to hold on to it. You can see 23. In 2010, again, it remained above 20, slightly overvalued. You can see here, October, it became expensive, 25.2, and then it started coming down. 2011, it started coming. So basically, you could have sold it in 2010 when it was at 25.2, and then you could have waited till 2011 August, 18.24. This is the opportunity, or even in June, 20.34. Here you could have started buying. So the entire second half of 2011 was a buying opportunity. 2012, again, the entire year was a buying opportunity. 2012 and 2013 were years of consolidation where nothing was happening in the market, but the companies were doing really well. The market remained extremely cheap for 2 to 2.5 years. Even in 2014, you can see it remained cheap till May when the next government came to power. After that, it started becoming overvalued. So these 2 years were phenomenal opportunities to keep buying. So June 2014 onwards, it became slightly overvalued. So 2015, you could have kept holding it. It went up and up, but it didn't become very expensive. 2016, you got an opportunity in February. There was a crash, which was an opportunity to buy. So again, it remained overvalued for a period of time, but it never became expensive in 2016. 2017, again, it remained overvalued, but it never became expensive in the first half. In the second half, it started becoming expensive in 2017. You can see 25 plus, 26, 26. So this is the time to sell and wait. But what happened in the next 2 years? The market remained expensive in 2018 as well. The entire year of 2018, the market remained expensive. It didn't fall at all. So 2019, the entire year again the market remained very expensive. It went up till 29.24, which is very, very expensive. You can see the color here, red. So it started going down, it started facing a dip. So this is a red flag. So you can see that 29 in April 2019, right? This is the time to sell everything and wait for 9 months, 10 months, 11 months, and then COVID happened. And you started getting the companies at very cheap valuations. So this is one place where this method did not work. So basically, what happened during COVID was companies lost huge revenues. They lost half of their revenue, 75% of their revenues. So basically, their EPS went down, because of which the P ratio remained very high. So this was a period, right, in 2020 as well as 2021. I felt that the market was expensive because I looked at this ratio 32, 33, 34, 37. So I kept saying that market was expensive. So in March 2020, I tried to purchase shares, but it was a time where we could not get loans. The entire country was under lockdown. Banks stopped issuing loans. But in late 2020 and early 2021, I kept saying that the market was expensive because I used this method. This method did not work during this period. But ideally, I should have looked at 1 year forward EPS instead of trailing 12 months. So we have been looking at trailing 12-month EPS. Instead of that, you can also look at the next 1 year EPS. So last 2 quarters were washout for Indian companies. The revenues results were very, very poor. So in case if this continues, if our GDP growth slows down, then our EPS may go down. You can look at the next 1 year. So 6.5% GDP growth is possible. Then EPS can also grow at a similar range. So if you look at 1 year forward and if you look at these numbers, maybe Nifty could be cheap even now. So this is how it occurred in 2021. Now let's look at the next 2 years, 2022. So basically after 1 year, all the companies started showing normal revenue. So the P ratio came back to normalcy. So 2022 June, opportunity to buy. So again, it is slightly overvalued, but these are places where you could have still bought. 2023 again, it was still below 21, 22. So the entire year was slightly overvalued. 2024, if you look at 2024, we can say again the market was hovering between 20 to 25. So there was no clear sign of a market fall in October. So in September 2024, we peaked and our P ratio was 23.61. After that, though the market fell down as well as earnings fell down. So the market fall was not as big to start buying. 23.3, 22.243, 22.4. Now, if you look at it in current year, 21.36, it is coming towards our range, 20.48, 20.05. So basically, last month was a phenomenal opportunity to start buying shares. So now, currently, it is at 21.09. Today's value is 20.82. So we are getting close to that undervalued zone. So what you can do now, this is how the P ratio looks based on the current DPS. So at the current price, we are at 20.82. In case if market falls to 20,225, let's say tomorrow if there is a 1,000 to 1,800 point fall or a 2,000 point fall, we'll go below 20. Even if there is 1,000 point fall tomorrow or in this week, if we hit 21,000 in Nifty, it is a zone where you can start buying. So at 20 to 25, this is what happens. P becomes 19, 160. If it goes to 18,000, it is again very cheap. If it goes to 16,000, this is where you have to be more aggressive in buying. So these are the ranges where you can actually start buying from 21,000 till 16,000 if at all the market goes to that space. So from 21,000 to 16,000, this is a good range. Keep buying in a staggered manner. So with this basic thumb rule is something that you can use to find out if the market is overvalued, undervalued, expensive, or cheap. Based on that, you can make your buy sell decisions. So this is very, very simple and easy to use. Even the top investors use this metric to do all these things. So in our next video, we'll talk about whether you can continue with SIPs in a falling market or should you stop your SIPs. So that is another interesting opportunity we'll talk about in the next video. If you want to uh, keep getting educated about investing, keep following our channel, subscribe to us, like this video, and share it with your friends. Thank you. Happy investing.